What's up, guys? Thank you for taking some time out of your night to come listen. Tonight we're going to do a real quick, short and sweet lesson. It's about supply and demand and the how I trade supply and demand for the best risk to reward setups. So there's tons of different benefits of why using supply and demand is very probable. Because if you think about it, the only way supply and demand imbalances actually form is from big institutional traders. So the only way that the market can actually move is economics 101, supply and demand. If there's excess supply, then over the demand, then the stock's going to go down. If there's excess demand, then the stock's going to go up. If the buyers and sellers are agreeing on price, then it becomes pretty much choppy and equilibrium, right? So I like to enter in these imbalances zones simply because I'm entering with big money, right? So you get some very, very great risk to reward trades. So I want to kind of show that real quick. So if I look right over here, I put some supply and demand zones up. If you want to check out the actual full length of how I identify them, here's that. But for today's lesson, we're only talking about how I trade them. So the four different imbalances are rally base rally, drop base drop, drop base rally, and rally base drop. So as soon as you identify these four main structures, you're going to have a much better time trading because this is how the market moves. These are the four major structures of how the market will move. And as soon as you can recognize this, you can get some very good risk to reward trades. I'm talking like 10 to 1 risk to reward trades, 20 to 1 risk to reward trades. You can get some very insane risk to reward trades. So the imbalances, so we'll kind of talk about this one. This one happened today, so this is a fresh supply zone. So there's three major criteria of how you get, in this case, a supply zone. So for this one, it's a rally base drop. So what happens is you get that swift rally upwards. Here, let's go on the 6 hour. You get this swift rally upwards. You get the basal candle, which is pretty much the equilibrium candle. So the buyers and sellers are agreeing on price. And then the third criteria is that major imbalance. So at one point in time in this 6 hour time frame, both candles pretty much had the same exact they started at the exact same thing. So this one formed right by it, right? So this is very important to understand. We went from balanced market, and then once we had this sudden drop down, that is when we became imbalanced. This is how we form the supply zone itself. So when we get the supply zone, it's basically saying, hey, retail traders, us hedge funds are leaving you some breadcrumbs in a sense. So in this specific area, there's going to be leftover sell orders. Limit sell orders are going to be sitting here. So why is this important? This is important because we can structure some very good trades around this knowledge. So what happens is, all right, let's paint the picture real quick. Let's say price action is going up, price action is going up, and we'll do two different scenarios. Let's say I'm already in a call position. I enter calls somewhere down here, and I already know, I'm a savvy trader. I already know that there's a supply zone right here. Therefore, there's going to be sell orders waiting to be filled. So I want to be selling into this. If I'm in calls, I want to be selling into this pressure on purpose for two reasons. Reason one, the implied volatility will be in my favor. When we sell into these pops, into this pressure, implied volatility will be juiced. When the implied volatility is juiced, what happens is our premiums for our contracts will be more bang for our buck. We're going to make more money. So we want to be efficient with this. We always want to sell into the pops, not the drops. You don't want to sell it while it's retracing. You want to know the data. You want to see, hey, there's sellers sitting here. I want to sell into this on purpose because I'm going to get more money. I want to be more efficient, right? So then what happens is just to go back to scenario 1. Okay, I'm in calls. I know that there's a supply zone sitting here. So I can go one or two ways. If I'm in multiple contracts, you can take most of them right off the table. So let's say you're in 10 contracts, take probably 7 or 8 off the table right then and there, because if you don't, there can be a very swift reaction and you can just go plop really quickly, right? So you want to be super aware of that, because you have to realize there's leftover sell orders sitting right here. So, and then when they get triggered and when they actually activate and be filled, this drop can be extremely quickly. Like it can be a dollar drop in as much as 15 seconds. So you don't want to be messing around with this, right? So you want to be taking your profits as soon as we come into this area. You want to be taking at least 80% of your profits off the table. Then if you want runners, if you think, oh my goodness, the bullish pressure is still stacking up, the bulls look very strong right now coming into the supply zone, you could possibly hold 1 or 2 contracts just to let them ride. That's entirely up to you. If you want to do something like that, that's completely up to you. Now you have to remember that if you do something like that, it can very well reverse on you, remember? So that's entirely up to you. If you feel comfortable, if you're already in a lot of profits, I would just honestly recommend just completely cutting. That's personally, I would do that. Now, let's say scenario 2. All right. Let's say I missed the entire drive up. I'm coming late to the market, whatever the heck you want to call it. I'm just late, right? And I'm waiting for the supply zone. I'm not going to be opening calls right here because I'm a smart trader and I know that there's a sell order here. Now, this is important to realize. Supply and demand is different from support and resistance. Sometimes people kind of get them mixed up and act like they're completely similar. This is false. Support and resistance is historical data points that you find on a chart that happened 3 months ago, 6 months ago, 2 years ago, etc. Supply and demand are fresh. They happen basically every single day, and you need to refresh them as such. As soon as they're invalidated and they get pierced through, such as something like that, the price action pierces through it, this zone is no longer current. You get rid of this, right? So that's kind of something you want to be aware of. Now, something else, why supply and demand is different than support and resistance. If you were only looking at possibly a resistance zone right here, that's the resistance zone. You didn't have any of this data. You didn't have any of this. So this is giving you extra data so you can formulate better hypothesis and theses, right? So in this case, let's say you didn't know that this supply zone was here and you were only looking at this and you were in calls. You would have possibly got shorted and reversed on pretty quickly because you were only looking at the black and white, one specific line, and be like, oh, this is where I got to take profits, only here, but not looking and realizing the bigger picture is there's actually a big old supply zone of sellers sitting waiting to get filled, right? So this is why it's very, very important to couple supply and demand with your support and resistance levels, simply because you get extra data. Okay, data is king in this realm. Data is absolute king in this trading environment. So what happens next is, okay, just to go back to scenario 2, we get that bullish rally. Now price action's right here. So there's going to be 2 things that's going to happen. Let's say we see weakness. Okay, there's weakness, there's bearish pressure stepping up. Actually, first off, you're going to see the bullish pressure stepping down. There's going to be exhaustion. There might be some shrinking candles. That volume starts to die down. Okay, so now you see weakness. This is a good sign for you. You could be possibly entering shorts here. And your risk to reward is extremely minimalized. You already know your risk. Your risk is either, there's 2 different ways. Let's say you start getting reversed on here and the price action starts dropping. Your first tight stop loss is right above that current structure, right above this current structure where we start breaking down. This is your tight stop loss. If you want a wider stop loss, it would be above that box. So above this supply zone. Okay. So the reason being you have two separate stop losses because there's different types of days. What do I mean by that? Huge, highly volatile catalyst days, such as possibly federal meetings, when you can get some really, really screwy candles, such as like up, down, up, down, up, down. You've seen that type of moves, and they happen very, very violently. Those are basically stop hunts. That's a stop hunt. They're purposely trying to get your stop out and liquidate you. So that is why you would possibly have a wider stop loss. If the day is kind of like normal, it's a relatively normal day, not super highly volatile, then you would want to keep a tighter stop loss simply because your risk to reward is heavily in your favor, right? So then, okay, pretend you see weakness. We're getting a lower high and a lower low formation. Bearish volume is stepping up. You're getting some bearish candlesticks, maybe a shooting star, a spinning top, whatever the case may be. So you enter shorts. Now, this is where support and resistance couples in with your supply and demand. So let's say historical data point 293, 292, 291, 290, all that type of thing. So these historical whole number psychological numbers are your targets, right? So you already have your targets predetermined before you even enter a trade. So these are, in a sense, your quote unquote minor targets. Your major perfect picture perfect level target is that demand zone. This most current demand zone is your final target. Now, obviously, it's not going to hit every single time, but that's your final target where you want to take all your profits off the table. These are your more minor targets per se. Obviously, there's still going to be lots of reactions, especially at 290. So you want to play it by ear. Not every single trade is static. Every single trade is dynamic. There's always going to be some minute differences every single trade setup you take. So you always want to be thinking on your feet, because if you see some weakness and you see some bullish pressure start, possibly bouncing here, and you're in puts, obviously you're not going to just not take any profits. You're going to start taking some profits if you see bulls stepping in, right? So you have to play everything by ear. Okay, so let's map it out. Perfect. Okay, I enter. Let's say here's where that high is, where we start getting reversed. I'm going to wait a little bit for confirmation. Let's say I wait 2 minutes, 3 minutes. Here's where I enter, right here on that lower high. Okay, so my stop loss we already deemed right here, right there. Give a couple pennies so we don't get stopped out. And then the first real target would be here. Now, this isn't that great, right? But you have to think about something in this way. There is something called planned R multiple and realized R multiple. So the planned R multiple, it's a fancy term saying risk to reward, is this 2 to 1. But we're savvy traders. We're not keeping the stop loss the same. Well, if the price action is down here, why would we keep our stop loss way up here? We keep bringing it with us. So in this case, our stop loss is now right above the structure we entered at. So now, if you look at it this way, and when we go back to our, let's say we enter here, and our price action is going our way to the first target, that once relatively mediocre setup of 2 to 1, but simply because we kept moving our stop loss down and not keeping it the same, it turns into a 14 to 1 risk to reward trade. And that's just stop 1. Imagine if we get to stop 2. And you have to realize our stop loss is still moving down. We're not sticking up here. If this is the most recent rejection, let's say it's right here, that's the most recent rejection, our stop loss is now right above it, right? So in this case, we're in a risk-free trade, right? We already, we entered here, even if whatever reason, you wouldn't do this, by the way, but for whatever reason, if you did not take any profits down here and we start going right back up and it hits your stop, then you're not losing any money. clearly you don't want to do that. You want to, take your profits along the way. But I'm kind of emphasizing that your 2-to-1 risk to reward basically becomes a 25 almost risk to reward. It's very, very extreme. And this is the importance of, you always want to move your stop losses with your trade. So if this trade is going your way, why would you keep your stop loss way the hell up here and allow it to, okay, the price action is down here, but my stop's way up here? That's very foolish, right? Because you're basically saying, okay, I'm fine if the stock reverses way up here. Like, you're not securing any profits, and that you're not allowing your stop to be tighter and tighter. We have to be efficient with this, and we want our stops to be very, very tight, and we want to just keep moving them down and down and down. Or if we're in calls, we just want to keep moving them up and up and up. It flip-flops. So supply, boom. And we already deemed there's a demand somewhere down here, just for sake of time. There's the demand zone. There's my final target. And then what happens is, back to the exact same example, there's the recent rejection. Here's where I enter right there after we get some sort of confirmation. There's my stop loss. Let's say this is my first target. It's all the exact same thing. And now, something that's very, 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 very important, I actually struggle with this when I first started trading supply and demand. Just because the price action is entering the zone does not mean you automatically take a position. Because sure, sometimes it might work in your favor and bounce or reject. Sometimes that works, but that's not the case all the time. So you want to be very aware of this, and you want to have some sort of confirmation. You want some sort of confirmation for sure. And this way, doing so, you allow yourself not to get faked out. Because if you get faked out, then let's say you enter right at the beginning of the zone, and you think, okay, there's going to be some sort of a drop. But what happens if the price action just goes way up here? You just got a really, really bad entry. You got a really bad entry, right? So that's why you want to be mindful of looking at the price action and the volume. Like, if we're making a higher high and a higher low, which is bullish, it's a bullish structure. If we're making that inside of a supply zone, that is not the time to buy shorts. If we're making a lower high and a lower low, a bearish structure, that is not the time to buy calls. So you have to understand how the price action is setting up, right? And you also want to look at the volume and see if the volume is stepping up or not. So that's just kind of a good tip. Just because we come into one of these supply zones or these demand zones does not mean you automatically just immediately buy calls or puts or any of that type of stuff. You don't do that. So that's very, very important, because I unfortunately learned the hard way to not do that. I took a couple of different losses by pretty much just immediately we came into the supply zone. I'm thinking to myself, I want to be savvy. I want to enter real quick, but then it just keeps on going, or it doesn't reject or anything like that, right? So that's very important to understand. Now, so something for tomorrow, we actually I forget what time frame it was on. One sec, let me find it. So there's one right there. 1 second, let me see if there's anyone intraday. So far, I think this is the only real one. Real quick, just to make sure. So that one's already been tested. That's been tested. Okay, so yeah, this is the most current one, which would be right. Where'd it go? Here. Okay, so this is our next major demand zone. So what we have is a drop, basing, and a rally. So it's a drop base rally. So you chart the top of the body to the most lowest wick. So that's our major new fresh demand zone. So that's pretty much where our major target will be, where a lot of liquidity is willing to step up between 287 and 285. Makes sense. They're both psychological whole numbers. So then you can kind of formulate a game plan around that. So this is low of day, right? So that's low of day. We need to see low of day actually hold. If low of day does not hold, there's a very good possibility that we can continue lower and continue down to this demand zone. So let's say we do a real life example of something that has already happened. Just do a real life example. Okay, this one. So not every zone holds strong every single time. This is another reason why we don't just buy blindly into a zone. So in this case, this is a 4-hour June 28th. We'll go down to a smaller time frame. Okay, go back over here. So this happened a couple of days prior, and then we finally came back in about a week later. Supply and demand zones stay current until they become invalidated. They can stay for 2 days. They can stay for 6 months. They can stay for 2 years. Does not matter the time horizon. You have to realize the institutions don't care about time horizon. They care about the best possible fills. So if you look here, there's the supply zone. So this one worked out kind of, but it didn't really work out that much because the bullish pressure was pretty strong this specific day, right? So what happened was we pretty much rallied very, very strong, had kind of a little consolidation bull flag, had another drive up. And then as soon as we came into the supply zone, because we didn't come into it officially right there, but we came into it right here, we had some of the orders fill. So the orders filled, we dropped back down. And then that secondary time, we actually came back up. And then this, once we get a secondary rejection such as this, and we see this type of candle forming, that's a very bearish candle. That's very, very bearish. So we could be entering on either this candlestick when we get the retracement and we made a lower high. So that would be a very ideal entry right there. Or we could, if we're on the lower time frame, such as maybe the 2 or 3 minute, we might be able to either enter on this time in this specific candle frame, right? So then you already know your stop loss. Your stop loss is right above this area. Okay. So let's say you didn't enter, you entered on this candle. And then you would keep your stop loss a little bit wider. You don't want to just keep it like right above it because you want to give yourself a couple pennies, maybe like 20 cents or so you don't get stopped out, right? So in this case, you wouldn't have gotten stopped out. If it ended up coming back up here, you would have been fine. Or let's say you didn't enter in this specific candle, you entered right here. Same exact mentality applies. This is the most recent high, so you keep it right above it. And then you enter either here or in this candle, regardless, whichever one you do, you already have your major targets. So this is where we had some area of participants before. If you look at the chop, we had lots of participants step up here, lots of participants, lots of choppiness, lots of pretty much indecision, right? So what happens is that's your major first target right here. Once we had these 2 bounces, that's an area of support. So if you look, that's pretty much where we first got bounced out. So that's your first major target. So let's say, just to map it out visually, let's say I didn't enter up here. I entered maybe, let's not give ourselves a picture perfect entry. Let's say we enter somewhere right there, right? Something realistic. So that's my stop loss up there. There's my first major target right there. So this is still a 2-to-1 risk reward trade at a very highly probable setup because it's the supply zone. This is where big money is trying to step in at, right? So, and then you keep kind of running it down to there. Okay, so this is another area of where participants stepped in that specific day. And look where we came to. We came right back there. So let's say we don't snipe the bottom, but we end up cutting pretty close to the bottom. This is still a pretty decent risk to reward trade, even with a relatively large stop loss. Now you have to remember, my stop loss is coming with me. So my stop loss, since we're way down here, is now above this structure. So this is the most recent rejection. So my stop loss is now above that. So that once relatively mediocre 2-to-1 is now a 5.5-to-1 because my stop loss is coming with me. You don't keep your stop where you originally placed it at up here if the stock is going in your favor, aka it is. So you want to move it above, in this specific example, since it's a supply zone, you want to move it above your recent rejection. So right above this recent high. It's completely flip-flop for a demand zone. Let me see if I can find a demand zone that actually worked. There we go. That's fine. Now this one did not work. Actually, let me go in a larger time frame. Another good tip. You're able to find supply and demand zones pretty much all the time, but I wouldn't recommend finding them on the 5-minute time frame. It's not very reliable. So I'd recommend at least bare minimum going like 7-minute time frame, and that's like bare minimum. The same exact mentality with support and resistance. The larger the time frame, the better the merit, the higher the merit. So let's say we find something maybe on the 30-minute real quick on an intraday basis. Right here, here's one that's recent right there. So we get the rally up, we get the consolidation, we get the rally up. So this is a rally base rally. Boom, boom. Just to chart it, you go from the top of the body to the most lowest wick, right? That, okay? So this is a demand zone. We mark it green just so we don't forget. And if you look, it came into it today briefly. So let's go on a smaller time frame. We'll do the 3-minute this time. So if you look, this worked out, not very super strong, but it worked out nonetheless for a relatively decent trade. So I already made this area beforehand. 292 is a psychological whole number. Don't even have to look at the chart. I know that this is an area where participants will step in. So in this case, if you look, we come into the zone, we bounce out relatively aggressively, and then it kind of stalled out. If you look at the volume, this is why you want to look at the volume. So we come in, we had a very big, pretty much very big volume candle. So that's a good sign. That's a very good sign. Now we want confirmation, we want to follow through. The next candle was pretty indecisive. We had pretty much just kind of a long-legged doji, relatively indecisive. Look at the volume. That volume is weak. That volume is very weak. It's almost half the size of this one. We had no follow through. We don't enter on this candle, right? Because we can get a better entry. In this case, we would have. So in this case, maybe you didn't enter here, perfectly fine if you didn't. But once you start seeing that lower high being formed, right? We're turning into a possible bullish structure when we get that bounce of a lower high being formed. Or excuse me, I'm sorry, a higher low, apologies. So you could be entering somewhere down here, right? So let's say we enter somewhere down here in this candle and we start seeing volume stepping up. This volume is starting to step up more bullish. This is what we want. And let's say we enter here, we need to see continuation. We need to see a follow through, because if we don't get enough volume, we're not going to make an aggressive move. In this case, we actually have a little bit more volume than its predecessor. So this is considered follow through. This is what we want. Okay. So then that's another reason why we had a move something like that. And then we had more follow through. So the volume is still there. We had a little bit of bears stepping up here, but still, it was still relatively bullish. So we had another follow through. And then we came right to our target. We would have had this target in mind before we even entered the trade, because it's a psychological whole number. That's one of our major targets. And if you look, we came right to it and just dinged right off of it. So let's pretend we'll do another risk to reward trade setup. Let's say I enter, maybe let's give it a realistic entry. Let's say I enter maybe right here. Okay, I enter right there. All right. And I already know my stop loss. It's underneath this recent low. That's my recent stop loss. So under that low is my stop loss. And then I already have my predefined target right there. So right off the bat, this is still a very good trade, 3.5-to-1 almost. But you have to realize my stop loss is coming up with me. If my price action is up here, my stop loss is no longer down there. It's now going to be under at least this one. This is the another low, right? So I at least want to bring my stop loss at least a little bit higher. So now we went from a 3.5 to a 9, right? You kind of get the point. you bring your stop loss up with you. So let's say we're way up here now. Our stop loss is no longer down here. Our stop loss is going to be underneath. Let's say we're right here. Our stop loss is underneath this low right there. So that's our new stop loss. Let's say we're up here. Our stop loss is now right here. You kind of get the point. You move your stop with your trade. In this case, since it's bullish and it's a demand zone, you put your stop loss underneath the recent low. Whereas if it's a supply zone, you keep your stop loss above the recent high rejection, right? It's kind of just mirrored flip-flopped. So that's pretty much how I like to trade supply and demand. I wait to see how, when we come into the zones, I wait to see the reaction, if volume is stepping up, if we're getting any follow through. If we are not getting any follow through, then I wait. I want to wait for confirmation. And then I just pretty much put my risk to reward trade zone. If as long as it meets my criteria of at least 2-to-1, perfectly fine. Because I know if the trade goes in my way, then I'm moving my stop loss along with the actual trade. So it's not going to be a 2-to-1. It's going to be something higher, something greater, if it goes in my way, that is. Right now, another thing about supply and demand, the reason why I like it so much. So let's go back up here. Let's say this is my demand zone. This is my supply zone. So let's pretend everything in between is considered chop. Everything in between is considered chop, and I don't trade it. This is mostly retail traders and mostly retail traders and small liquidity. So what happens is you have to realize these people are small fish. They're not really going to move the market extremely. The people that are going to move the market are within these zones, and the supply imbalance or the demand imbalance, because these are where the orders are trying to get filled. So the mentality with supply and demand trading is you don't trade in the chop. You don't trade in between here. You wait and you're patient, and you either trade in this area or in this area. You don't trade the middle, because you can get faked out a lot if you trade the middle. Now, the pros and cons of this are: pro, you get a lot better risk to reward trades. You're a lot less stressed because you're not just looking at every single tick. You're not looking at everything on the chart. All you're doing is setting an alert, be like, okay, there's an alert. If it comes above this area, I'm going to be alerted, so I can kind of see what the price action does here. Okay, if we come down here, there's my alert. So you don't really do much, right? Now, you could consider this a con. I wouldn't really necessarily consider this a con myself, but you don't trade nearly as often because you're only looking for highly probable A+ setups. And these are the A+ setups because you're trading with the hedge funds. You're not trading against the hedge funds. So let's say hypothetically you take 10 trades a week, right? Let's say you take 10 trades a week, but because you're not trading in the chop area anymore, your trades are much more selective. So you're not trading in there, you're only trading within this zone or within this zone. Okay. So what happens is maybe instead of 10 trades a week, you will take 5. But just because you're trading less doesn't mean you're not going to make money, right? Because these setups are going to be highly probable. You're going to make a good bit of money, especially if you're letting them ride, right? You're not just taking profits really quickly. You're letting them ride, okay? So what happens is, yeah, sure, you might not be taking a lot of trades, but the trades that you do take are going to be much more highly probable. And another fun fact, you don't have to trade every day. You don't have to sit there for hours and hours a day. That's you do not want to do this because it's just you're going to really strain your mentality. You're basically, mentally exhausting yourself by looking at the charts every day. Not every day is a trading day. Not every day is a trading day whatsoever, right? So you have to realize this pretty much off the bat, because if you don't realize this, then what happens is you're going to be over trading. And when you over trade, then that's when you end up pretty much um, when you over trade, what happens is your trade selections might not be the best, and we don't want that. So I'll give you a prime example, right? I'll give you a prime example. So a friend of mine, he's a six-figure trader. He trades one setup only, nothing else. If his criteria is not met, he does not trade. It might take him 3 days to get a criteria set up. It might take him 8 days to get a criteria set up. Whatever the case may be, he'll wait, he'll be patient. And when he does have that specific criteria set up, because he knows that, hey, I've seen this set up hundreds and hundreds and hundreds of times. Okay. So I'm going to go heavy. And if it goes my favor, awesome. I'm making a lot of money. If not, I already have my stop loss in place. Right. And just to answer your question in the chat, what is your criteria? Everyone's criteria is different. I might trade differently from you. You might be a scalper. I might be a day trader. We have different criteria. This is why you must know what your specific criteria is that meets your standards. But regardless, it doesn't matter. You find your specific criteria, your specific setup that works for you, and that's all you trade. Me personally, it's supply and demand. I like to trade supply and demand imbalances because of the reasons I already stated. Your risk to reward is heavily in your favor, and you're not really mentally draining yourself. You're literally just taking the trades that come to you. You don't chase the trades, you let the setups come to you. And I already have my setups. It's either going to be in this area or in this area. That's it. I'm not trading the middle. I'm trading in this supply zone or in this demand zone. That's it. Nothing else. So that's my supply and demand method. And now I already, I have other different criteria, but we already kind of talked about the main criteria is volume, price action. What structure is it in? Is it weak? Is it not weak? All that type of stuff. You don't have to overcomplicate it. You don't need 30 different indicators. The only indicators that I use is a VWAP and 200-day moving average. Everything else, my charts are completely clean when I'm actually intraday trading. So hope that lesson really helped. If you want more of an in-depth lesson of how I actually find the supply and demand zones, in this specific time lot, I had a little bit of limited time. I did create a very nice video. If you want to check it out, I'll link it here in the chat if you just came recently. But definitely something to check out if you're curious and want to trade more of this type of stuff. Highly recommend it, especially if you're you're struggling to find a specific thing that you like. This is something that you should check out because it's very helpful with your supply and with your criteria and with your setups, because it allows you to be more disciplined. Instead of over trading and taking a shit ton of trades, you only take predefined trades, either a supply zone or a demand zone. That's it. Okay. Anything else? Do you guys have any questions? I'll take questions for a couple minutes and then I'm going to end it since Kev's lesson is going to start soon and I don't want to go into that. So just if you have any questions, feel free to ask real quick right now before we end this. Did you say the 200-day moving average? Yes, I did. So 200-day EMA is what I use for day trading, exponential moving average. If I am swing trading, I use the SMA, the slow moving average. What is VWAP? Great question. I put a video on my YouTube of how to trade the VWAP. It's about 10 minutes long. Highly recommend checking that out. One sec. Let me just keep reading. What time frames do you use to make your zones? Awesome question. I love that question. So you actually want to do multiple time frames. You don't want to just be like, okay, I'm only making my supply zone the hourly. I'm only, you don't want to just have one specific thing. You want to start top down, just like your support and resistance. Hey, is there any zones here on my daily? No. Is there any zones on my 10-hour? No. Is there any zones on my 6-hour? Yes. Boom, boom. Right. So then you keep going down and down because you can actually find multiple zones inside an already zone. Like it's not improbable to find 3 zones inside of this area, right? So the more zones you find inside of each other, the stronger the zone. Hope that answers your question. 1 second. Do you use level 2 data at all? Yes, I do. I use level 2 and I read the tape. I also made a video on my YouTube if you want to check it out. What volume indicator do you use? Yeah, good question. So this is called the buy sell indicator on TradingView. There's another one on Thinkorswim, buy sell indicator. I think it might be more customized. So if you can't find that, just send me a message in either Discord or Telegram, and I can send you my script. One second, just still reading. How far back do you usually go with your zones? As soon as they get, like for example, this was another zone, like right here. This is a zone from prior. This zone got invalidated, right? As soon as we pierce through it, it's invalidated. I get rid of it. Oops. I entirely get rid of this zone. So you always want to keep your zones fresh. So like right now, these are the 2 fresh zones, right here and right here. There's probably some intraday like right in between here somewhere, but these are your main zones that formed recently. So these are the zones that you want to keep until they become invalidated. If price action pierces through here or pierces through here, then they're invalidated. You get rid of them. Newsletter you made today was this very helpful. Hey, thanks. Appreciate your kind words. It means a lot to me. I appreciate the way you break things down. Do you offer mentorships? Wow, I appreciate the kind words. Yes, I do. I'm also doing a group session later this month in about 2 to 3 weeks. It's going to be 30 hours long, 3-month duration, pretty much A to Z, how I trade, what setups I trade, all this different things. If you're curious, feel free to message me on Discord and or Telegram. Thank you again for your interest. Appreciate you. Any other questions? Let me see here. Do you use pre-market data for supply and demand? Yes, I do. Great question. Yes, always keep your pre-market data on. Very, very important because you can see other information that you might not have seen if you turned it off. Great question. How did you find the green zone on the bottom? I believe it was the 3-hour, something like that. I forget which time frame it was. Here's one right here, and then I forget exactly which one I charted. I think it was, yeah, it was this, no. This one, yeah, it was right here. So there's the wick right down there. So I go from the top of the body of the equilibrium candle to the bottom of the wick. If you want more of an in-depth version of how I do this, I'll link my YouTube one more time for this supply and demand video. Just one last time. Definitely highly recommend checking that out. If you have no idea what supply and demand is, highly recommend checking that out. What happens when the market gaps over a supply zone? Great question. It invalidates. It doesn't matter if it's pre-market. If the price action pierces through it, it's invalidated. Great question. How did you get the name Scrub Nugget? I don't know. It's just funny. I like to consider myself a scrub because if you think about it, if you compare yourself to people that trade for 10, 20 years, there's tons of different people that are highly advanced that you can still learn from. You know, the market is ever growing and ever learning. So it's a very cool thing that you can learn, one thing a day and you'll still be learning 6 years from now. There's always stuff to learn. So that's It's another reason why I call myself a scrub. But yeah, cool question. Um, any other questions? I'm going to end it here in a second. Just any other questions? How do you find support and resistance levels? That's going to take more than a minute. So I will just show you the video real quick and then link it. It's a support and resistance video. Highly recommend this one as well. It's how I make all my levels. So these two videos that I link in the chat, the supply and demand and the support and resistance, honestly, really highly recommend checking those out. Simply because it will really elevate your trading with because you want to have the correct data. You want to have the correct data. So definitely recommend checking that out. But anyway, I appreciate you guys for listening. If you guys have any questions, if you have any questions at all, feel free to message me on Discord. There's my Discord tag, Telegram tag, my Telegram scrub. Appreciate you guys for listening. And to the guys that were inquiring about mentorships and anything like that, just DM me privately. We can talk. Thank you again for your support and your interest. My next session will be talking on Wednesday around the same time frame. So if you have anything you're struggling with or anything you want to chat about, send me a message and I'll create a lesson plan about that. Or if you want me to help you with break down some of your trades, if you're struggling with any of that type of stuff, always happy to help a fellow trader. Thank you again, guys, and good night. And I'll see you guys tomorrow.